I'm going to kick it off here real quick, but before I get into the crop component of what's going on in markets, I do want to talk a little bit about inflation, interest rates, and stock markets. Obviously, it's something that is in the press right now. It's an important factor both for the general economy, but does have ramifications in agriculture as well, obviously. I do want to give just a quick update on the Ukraine-Russia circumstance, because that is one of the dominant influences in wheat markets and corn as well. And so that's something where it continues to drag on and has some longer term potential implications as we look at this year's crop and into next year's as well. And then obviously we talked a little bit about fertilizer, but I want to talk about a couple of the other input prices we've seen. Obviously, we're in an elevated price environment in terms of cost of production. We need to factor that in when we're looking at how we're marketing our crops. And then I'll close up with supply and demand and a little bit on corn, soybean, and wheat prices. So the first one I just want to point out, I'm sure most of you have probably seen this number.
The audio is terrible, Aaron. I don't know what's wrong.
The audio is? Let me just check that.
I can hear you fine. Everything here is clear on my end.
Okay, I'll try to speak up a little bit more then. But most of you have probably seen this inflation number that came out in May, 8.6%. It's the highest in 40 years. Now, what we have to do remember is when we started seeing this elevated inflation, we started it kind of in the middle of 2021. And so the red arrow that's on the screen there shows May of the previous year where we were at 5% there. So we're starting to get accumulated effect on that. And so again, that's something that's going to be very important moving forward. There are a few methods that the Federal Reserve have at their discretion to end up lowering inflation, interest rate increases, and ending up purchasing back some of the assets that they've ended up distributing over the course of the quantitative easing that they ended up providing. The other thing I do want to highlight is that inflation across the board at 8.6%, but there are specific categories where we've seen incredible elevation. I'll point out the gasoline and natural gas up 48 and 30%, and vehicles up 12.6%, food up 10.1%. So again, when we look at these individual categories, there are some that are incredibly important for ag. We'll talk a little bit about that in the input prices section. We've mentioned interest rates as a key to end up combating inflation at the Federal Reserve. I'm pretty sure today they're going to raise interest rates. It sounds like 0.75%. It's somewhere between 0.5% and 0.75%, which is a pretty substantial increase when you look at it in terms of a historical context. There's a lot of speculation that for 2022, we are likely looking at a 2 to 3% increase in interest rates. And so if you think of where we're at as of June 2022 at 4% for a prime loan rate, we're looking at probably 6 to 7% by the end of this year. So again, it's going to increase the cost of the capital required to run businesses. And so that's something that is going to be important. Hopefully people or farmers have taken the opportunity to appropriately structure their long-term debt, hopefully locking in some rates over the last year. I know we've been talking about that pretty extensively, but that is something I think is very important. And so when we look at interest rates, it's going to be something where there is going to be a substantial increase moving forward. We look at the stock market. I'm not going to dwell on this too much. I'm sure those of you that have investments in the stock market are aware of this, but we have seen stocks come off the highs that were at the start of this year, and we're down 16.4% on the Dow, 22.1% on the S&P, and NASDAQ is down 31% as well. Andrew mentioned fertilizer prices. We have seen them start to ease a little bit. This is an index that is in the mid-south. And so it is something where it is, we have started to see it come down a little bit. We can see the urea. This doesn't show the dramatic increase that Andrew was talking about when we're down to about 650. I know I was speaking with David Bilderback, and he said that a lot of these suppliers have dropped their price on urea. I think a lot of that is there is some concern about potentially carrying high-priced inventory over. So again, that's something that I think is going to be important when we look at these prices moving forward. But the chance of us getting back to where we were in previous years is not all that good. We look at diesel fuel prices again, as we do start looking at our fall field operations and we're ending the planting season. Substantial increase in diesel prices compared to a year ago, where we're well above $5 on this in terms of a national average. This is one that I've had numerous requests for in terms of what custom rates are for operations, and this is one of the big challenges that we end up having. Is if you look at kind of the inflation that we've experienced, this little spreadsheet that we developed gives you the capacity to end up adjusting what charges would be for custom rates for various functions. So if you take a previous custom rate from the previous year, what this does is it adjusts the expense category for the current inflation rate or the 12-month percent change that's put out by the Bureau of Labor Statistics. And then it allows you to end up establishing a new rate. And so when we look at these different categories at different inflation rates, you can see that the increase in fuel, yes, at 48.7%, but when we factor in capital recovery and some of these other categories, we're looking at close to a 20% increase in the cost of operating machinery when you factor in the capital recovery as well. Look at natural gas. I do want to touch on this quick, and I'm not going to show propane, but propane follows a similar path on this. For those that have drying for grain this fall, it's going to be substantially more expensive. So again, that should be factored into what we're looking at in terms of drying down crops when we go into harvest. It's going to be an elevated cost. Where does it make sense? We're gonna have to take a good look and see what's going on in terms of prices. I did mention I want to talk about Ukraine, Russia. Obviously, it's an important production region, primarily for corn and wheat production. The maps across the bottom show, the key production regions for corn, soybeans, and wheat. Ukraine's not a big soybean producer. They're more into sunflowers in terms of oilseed production, but I did want to put that up there. But you can see that, compared to previous year, production is going to be down substantially. It's actually, I think, quite remarkable the amount that they were able to get planted based on where things are in terms of in terms of the challenges that they're facing both logistically and then obviously with the active combat zone still going on. It's still quite remarkable. When we look at that ramification for the export markets, exports compared to last year, corn down 63%, wheat down 44%. And you can see why it's important when we look at the 5-year average share of Ukraine for global exports, 14 and 10% of global exports for wheat and corn. That's expected to shrink down to about 5% for both of those, which is going to continue to reduce the amount of exportable available supplies across the globe. And I think that's been pretty well documented. Switch it up to where we are in terms of corn right now. Obviously, we had some challenges in the northern plains. It was wet, and so it's going to be real interesting to see what that June 30th acreage report ends up saying in terms of what we ended up getting planted for corn and soybeans. And so it is something where I think there's the potential for that report to be a market mover. We'll have to see what those final numbers end up looking like. And there are some places where there was some late planting that could have some yield ramifications as we move through the season. But when we look at this map, there's only about 19% of the corn production area that is under drought. We've started out reasonably well. Now, we all know how quickly this can end up changing. But again, we're looking at a reasonable start in many places, with possibly the exclusion of kind of that northwestern portion of the Corn Belt. I did want to put up this stocks to use number. It does give you an indication of where we are in terms of how much we have in reserve or projected to have in the reserve relative to use. And you can see the 2022 and 2021 numbers. It's important to note that traditional supply and demand fundamentals aren't necessarily the dominant market force right now. It is important when we look at it from a long term, because we will end up seeing it becoming or influencing markets. But as of right now, we do have this substantial increase. We're well above the trend line in terms of price. And again, I think there's some risk that's factored in there. There's a risk premium in the market. But if we do see good growing conditions and kind of some easing of some of the geopolitical issues that we've seen, we do have the ability for prices to come down you know, back closer down to that $6 level if we do end up seeing that. Now, again, there's a lot of time between now and harvest. We'll have to wait and see what ends up happening. The first big report that's going to come is going to be that acreage report. So it's going to be important. But again, we do have pretty good support because we do have tighter stocks to use. But again, you know, you could make an argument that we will see these prices come down as we remove some of the risk that's in this market. We look at the global picture again. This is the number of days on hand, so the amount of reserves relative to use. When we end up having this on a global scale, and you can see we're down substantially from where we were, but we still do have you know, pretty good amount relative to the last couple of years at 96 days of reserves on hand globally. When we look at the actual prices right now, obviously we've been trading kind of in between that 7 and 750 on the December contract. And when we look at that, it's important to kind of look and see where we are relative to what our existing protection is, whether that's, you know, are we looking at, do you have a bunch of crops that are forward contracted or hedged? But right now we do have a $1.30 price gap between where our crop insurance price, which was set back in at the end of February, and where we are right now. So that's a substantial price gap between our kind of base level of protection that crop insurance provides. And so one of the marketing tools that I think is very useful under current circumstances is using put options to establish that price floor. So I just threw out, you know, there's a $7 put option right now that you can get 50 cents or cost you 50 cents, establishes 650 futures floor. One of the reasons why I like this is you can end up establishing that futures price floor, and then you still have the ability to take advantage of beneficial basis movements as we move forward, because we do have very strong basis across most of the state. I chose Memphis, but we do have basis charts available for all of our geographic regions. It is important to note that this doesn't factor in poultry purchases, which is very important in many regions. Unfortunately, we don't have good consistent data over time on that. But you can see where we've been for the 5-year average versus what we've seen in 2022 so far. And then this goes all the way back to 2013, just shows kind of that consistency of, you know, we get seasonal basis drops around that harvest interval, and then we get a strengthening of the basis. And when we think back to this past winter, some of the basis quotes that I ended up hearing from farmers, we were substantially above where these elevator and barge points ones are, particularly when you're taking it to a poultry company. Switch it up to soybeans. I think one of the big ones, it has similar drought map as corn, where there's not a huge amount, 10% of soybean area is projected. The big change in soybeans right now is just this drive by soybean oil. Soybean oil has been really driving the soybean market. And part of that is because there's about 500 to 600 million bushels of additional crush capacity that are going to be coming online in the next couple of years. This is obviously driven by biodiesel, but we are seeing kind of a changer here. When you're talking about 600 million bushels, that's a substantial amount. And so there are implications for futures planted acres when we think about, okay, what is that traditional balance between corn and soybean acreage going to look, and other commodities to a lesser extent? Do we see a shift in that because of the stronger demand that is coming onto the market in soybeans? And then the other one that's important with that is exports and feed. And so if you think all of a sudden, if we're crushing 500 or 600 million more bushels, does that reduce some of our ability to export to global markets, or do we see that production increase that ends up offsetting or increasing the total overall production? And then if we're crushing more soybeans, obviously we're going to have more more soybean meal. So are we going to end up seeing, you know, prices come down on that, or are we going to see a more of a focus on exporting the meal than we have in past years? So this is more kind of a longer term discussion, but I think it's really important as we see what's going on. As of right now, I know there's some groups that are interested in putting in some crushing facilities in Tennessee, but I haven't seen anything that is a go as of right now. But I think this is an important thing to continue to watch in soybeans. We do have good support for soybean prices right now. When we're looking at where we're projected for the current marketing year at 14.75, you know, we're above that in terms of where we are in the futures. When we look at global demand, it's still very strong. They are expecting a bit of a bounce back in the reserves relative to use that we end up having. And a lot of that is driven by expectations of South America having a very large crop when they go to do their planting in the Northern Hemisphere's fall. When we look at soybean prices right now on the future side, again, we've been kind of between that $15 and $16 is where we've been bouncing around. But we do still have a pretty good upline trend on here. There's a 95-cent price gap between where the crop insurance prices are and where the current futures market is. And so again, taking some of that risk off the table, I think is a wise move under these circumstances. Things have been very volatile and choppy. I'm a huge proponent of getting a floor under a lot of production. I'm going to talk a little bit at the end of this, just some of the tools that I think are working well or can work well in the current market environment. But we can see that we have had very strong prices as we've progressed through this growing year. When we look at basis, again, we do follow those very typical seasonal basis trends. We do have the disruption from the trade war with China back in 2018, 2019 that influenced some of our bases, because we have to remember in Tennessee, we don't have a lot of domestic crush. And so we don't have a big crushing. So most of our soybeans are going to go out via our river system or hauled to an out-of-state crush facility. And so we are more subjective overall to export markets on soybeans than corn, where we have very strong internal use within the state and adjacent states. Wheat is one that's been obviously the most affected by Russia, Ukraine, but there is also the drought influence that is much more prevalent in wheat, particularly out in the southern plains. Substantial amount of wheat production is under drought, so 49% of winter wheat area, and 26% of that is in severe or exceptional drought. We look at kind of stocks to use. This relationship isn't very strong with wheat, actually. And so one of the things that we've been saying is the underlying supply and demand numbers don't necessarily reflect where we are in wheat markets. The dominant factor right now is obviously, can we end up having Ukraine access global markets, and what will the production end up looking at? So there's a substantial risk premium that's in there that is created because of that situation. So we see a pretty strong deviation from where we would expect things to be relative to what our stocks are. On the global side of things, we have seen stocks come down a fair amount. Again, a lot of that it can be partially attributed to where we are with Russia and Ukraine. So when we look at July wheat futures, this is one that I think yes, we're highlighting what's going on in wheat here, but we can use kind of a similar parallel in corn and soybeans. And I want to highlight how the crop insurance program ends up working. Obviously, you have your two price determination periods, depending on what type of crop insurance product you end up purchasing. But again, you get your projected price, which for wheat is established in the fall, and then you get your harvest price. And so when we look at that right now, there's a $3.50 price change between the harvest and projected price. So we are going to get some additional coverage for those that have crop insurance products that are adjusted to harvest prices, which it provides a much bigger or larger amount of protection. And so when we think about this kind of parallel to, because we will get an additional harvest price determination period for corn and soybeans, you can make a conceptual argument that the projected crop insurance price acts as a put, and then when you look at the harvest price, it acts more like a call. So it gives you a second chance in the market. If prices maintain where they are, we'll get a higher guarantee on our crop insurance products. Now, the key to me is, how do you bridge that gap, right? Because we can end up seeing prices go up and then come back down, where you wouldn't get that higher settlement. And that's why I think setting those price floors using things like put options or some type of option strategy, or even an HTA to end up assisting this, I think it does end up lending well to these types of strategies. Just to close it out before I turn it over to Andrew, I think now is a great time for producers to really look and see, well, where are my production estimates at right now? There's still a lot of risk out there. Obviously, things can change very rapidly, but as we exit this planting season, We should have an idea of our acreage, and then we have to, have some estimate for yield, but where's some reasonable production ranges in terms of how much should I have priced, and then again, how much do I have the ability to store? I'm a big proponent of being able to store the crop. It allows us to avoid, seasonally low prices at harvest, and we can take advantage of on-demand sales to feed companies and poultry companies. So again, I think that's something where you really want to kind of see, well, how much am I going to reasonably have for each one of my commodities? What's the storage available? How can I maximize the storage available and take care of that opportunity? When we look at the market right now, there is some profitable opportunities in spite of the elevated costs. Yes, everything is much more expensive, but when we look at where prices are and even a reasonable average yield, we do have some opportunities to end up capitalizing on that. So making sure that we are taking advantage of these opportunities when they present, I think is a big positive. And when I'm saying for how to use some of these tools, there's a big difference between establishing a final price and managing your price risk. And so I think that's really important, is to use things that I'll kind of take the bottom off the market, but do allow you to participate if prices jump back up. The other big one, that since we do have much more financial risk because of high input prices, it's a good thing, particularly like things like fertilizer, for example, when you are having those tremendous outlays, elevated costs, maybe taking some of that price risk off the table by selling or establishing a price on some of your commodities, I think is a very prudent move in terms of risk management. So when you're incurring some of these costs, laying off some of that enhanced price by securing a price on the corn or soybeans that you're doing. In terms of price projections, or pricing strategies, every operation is different. You do have to factor in things like storage when you want to end up selling commodities. If you don't have storage, I think you need to be a little bit more aggressive in terms of establishing prices, because you do want to avoid that kind of harvest period. So, somewhere between a quarter to a half of estimated production priced at this juncture is something that people should consider when we're looking at the current market. I am a huge proponent of setting that price floor through option strategies. There's several ones that I've discussed with producers in terms of, well, how can you end up making some of these a little bit more complicated than just a straight put option? You can end up going out and trying to offset some of that premium costs and create kind of a more of a fence type set of circumstances. There's lots of different strategies that can be implemented. And so I think, options are a good tool right now. HTAs are another one that I think when you're looking at locking in that futures price and setting that basis later, I think that works well, because I do expect us to have a strong basis in Tennessee, particularly for corn. I'm super interested to see where our planted acreage estimates for the state come in, just because with the high input prices, how much corn did we end up getting planted? But I think we will have strong basis for corn again into this marketing year. And then forward contracts. The one that I obviously didn't mention in here is just a straight short hedge. I think, I'm not necessarily down on it, but you do have to remember that with the volatility in the market, some of the margin requirements on that can be unpalatable for a lot of producers to end up taking. You have to have the liquidity to make sure that you can back that up. So with that, I'm going to